get banks to accept a lump sum payment that's substantially less than full balance, waive the right to judgment, of course, waive their right to report that settlement to the credit reporting agencies at less than the full balance. And sometimes that happens, sometimes it doesn't happen. So always, when you talk about that settlement with the client, you have to explain that there are potential tax consequences. So what are the potential tax consequences in a debt settlement? Very similar to the normal situation on a short sale, deed in lieu, which is that difference between the balance that's owed and the amount that's paid is a discharge of indebtedness, which potentially gives rise to a tax consequence. In other words, the client will get a 1099, almost always. Whether or not it's a taxable event, again, goes back to that client's individual tax situation. On the date of the discharge, so you cut a deal in January to pay 20 cents on the dollar, the client's going to get a 1099 in January, February 2011 for that difference. Whether or not it's a taxable event, again, depends on the client's overall situation. If their liabilities exceed their total assets on the date of the discharge, there's no tax consequences. How do you report that to the IRS? It's a separate tax form. It's attached to your 1040. It's basically a balance sheet. You're basically showing the IRS, these are my assets, these are my debts, this is why this should not be a taxable event. Any questions on that?